by Mehta Mehta team, Mehta Mehta. And we are doing it for last 1 year. So it's more of a learning. Every Saturday, we have this webinars on a different varied kind of topics. And today we have selected a topic called Valuation, Approach and Methodologies. And we have a best of the speaker, panelist rather, so Nitesh by Bhuta. He himself is a commerce graduate. He's also passed his CS examination. Unfortunately, has not taken his membership, so probably I would request, Nitesh by, if you need any help, getting a membership, I can help you. And also, he's a member of a Chartered Accountant Institute and also a registered valuer. So welcome you, Nitesh bhai, to this program, webinars. And we also have another panelist, Devang, Thakar, a friend of mine, by profession a company secretary. He has also done his master in finance management and also a diploma in system management. And also in last 1 year, he has passed many exams, including the insolvency examinations and registered. He's also now registered valuer. So welcome you, Devang bhai.
Welcome.
Learning never stops, Yeah, great.
Yeah, you're never old to learn new things.
And of course, our own Professor Bala, a regular article. I mean, he writes a lot of articles in the various legal magazines, including SEBI and corporate laws. And he comes with 4 decades of experience, and he has worked with a multinational company. Probably has spent a lot of time on a company called Foseco India. And he's always a kind of a guidance and a guidance.
Always an inspiration for us.
Yes, he's always an inspiration for many of us. So welcome you, Mr. Bala. And so without taking time, I'll request Bala to take over. Thank you.
Good morning to all of you. I have a great pleasure in welcoming you all for this seminar on my own behalf and as well as on behalf of Mehta Mehta. When it comes to the valuation, this is one of the subject, very much untouched by the company secretary professional. Somehow we think valuation is not my cup of tea or something like that. We don't get involved so much except we depend upon the experts and other things and all. Although there are many instances where the company secretary is being a principal officer, he will be held liable for anything goes wrong. That is one. Second thing is, generally we think, why do we need the valuation? Because we are not going to sell any assets. We are not going to any assets. Is it valuations required? That is one of the common question which is always being thought about to many people, but which is not true. Valuation has got its own importance. Because what happens is, even in our personal life also, ultimately, people would like to see what is my property is valuing today, what is increasing, what is decreasing. People invest, they constantly mark and they will see what is the value addition they have made actually. So when you have a business, and definitely having a valuation will definitely help you to create a future and also identify the non-performing assets due to the valuation, because valuation, one of the things which actually measures the progress. That is the bottom line of it. And you can identify the gaps by having the valuation and you can manage your business. It is a normal course, even when you are not buying and selling. But at the same time, when it comes to the valuation, if somebody is interested in getting into merger and amalgamation or acquiring some company or even buying some assets, etc., valuation is very, very important. And another thing is there, when the transaction is made, income tax specifically looks into whether correct fair valuation is done from the taxation point of view. So valuation has got its own importance. It is very significant. In fact, company secretary professional should get involved in the valuation. I would rather say it is one of the areas which is actually untouched for our company secretary fraternities for a practice actually. We have today 2 eminent faculties who are day in and day out dealing with the valuations. They will actually go to take us through why valuation is important, what is the necessity, what is the relevance, what are the various methodologies, and of course they will be also sharing their personal experience. I'm very sure this seminar will greatly give an insight of the valuation, and those who are thinking of starting a valuation as a new areas of the practice, they can think over it. I think that will give a sort of a moral boost to them to understand the concept. I'll request Nitesh to share some of his thoughts on this before we start the presentation. Over to Nitesh, please.
Thank you. At the onset, let me first thank Atul bhai. It's an absolute pleasure for me being a part of this presentation and learning on a Saturday morning. Thank you, Devang bhai, and thank you, Bala sir, as well, for being on the panel. And, I'll be learning a lot from your experiences and expertise as well. So, taking this forward from a valuation standpoint, if you pick up any pink paper, when I say pink paper, I'm talking about, let's say, Economic Times, Business Standard, or let's say the Mint of the world. And if you pick up any of these papers from the last 12 years, apart from the names of their newspaper, their respective newspapers, one thing that is common or that has been there in every edition, one word, is valuation. Pick up any paper and at least somewhere in that paper, you'll find a word, which is valuation, which talks about the fact that this particular profession or this particular buzzword has found a lot of prominence in the last decade and a half. Frankly speaking, it isn't that valuation is something new. Valuation has been happening since a century. But the idea is that prominence as far as India or as far as our country is concerned, you'll see there's a lot of talk with respect to valuation. So much so that we had a show launched last year somewhere, which is called Shark Tank India. And I think everyone followed that show, from a young guy who wants to start out, or from someone who's worked all their life out and looking at an exit. The buzzwords on lunch tables and dinner tables was valuation and what price are we selling and so on and so forth. And I'm not sure whether you've seen the new advertisements of the season 2, because season 1 was so popular. They've got a vegetable vendor talking about valuation. So that's the impact that it has created. All right. So the idea is that obviously, as there's something new, or whenever there's a new animal in the house and you're looking to tame it, there would be certain elements, or there would be certain companies which would go overboard and maybe overvalued. There'd be certain companies which could be undervalued. There's always this talk, right, that whether you should be Baiju's of the world or whether you should be the Zohos and the Zerodhas of the world, which are bootstrapped, or a particular entity which is continuously looking at Series A, Series B, Series C, so on and so forth. So the idea is, what I intend to take you guys through today is the fact that how do these valuations actually take place? Because if you look at guys who are sitting on those TV screens, every 30 seconds or 40 seconds, they were changing valuations of a company where underlying of the company was not really changing. So what essentially was happening over there, or what essentially is happening in the world, which is very, very critical. 6 months down the line, where there was no war, valuations of tech companies were over the roof. 6 months down the line, when there is a war-like situation, the valuations of tech companies have gone rock bottom, they've hit rock bottom. So the idea is that what's going on behind the scenes, what all goes in, how do we actually value companies, what are the difference between value, price, so on and so forth. So the idea is, for the next hour and a half, the idea is to discuss all of this, but more from a practical standpoint rather than theoretical standpoint. So that's the objective. Over to you, Devang bhai, for your thoughts.
Yeah, valuations is completely new science and other things. It was there already, but it's with Section 247 coming into picture in the Companies Act 13, it has given a completely new leeway. Second thing, at the end of the day, everything is value. Everybody who puts money needs something back and much more. So that concept of valuation comes in. It's just making a future projections and other things. What would be my future value? It's an art and a science combination together about it. Valuation by itself, the too many methods, the special emphasis is currently on startup valuation and intangible valuation. Physical valuation is very simple. If you have a land building, plant machinery, you do the depreciation, use the production output, it's an easy science. Where a financial valuation for enterprise and value, or a startup value, or an intangible asset, like a brand or something else, franchisee, other things, is a completely new science, and lots of thoughts and processes are going into it. Over to you, Nitesh.
So Nitesh, I probably before you start, just my thoughts, See, I've seen people, even though they have not started their commercial productions, and on their concept only, they are asking some billions of valuation. So probably I'll be very happy to hear from you. I mean, how does it people can take those kind of liberties and ask for such a billions or all?
Most of the people have the habit of valuing themselves superb. I may be a small-time actor, but I think I'm as good as Amitabh Bachchan. So I should get his price or better than his. So that's a very common problem.
Yeah, Nitesh bhai.
So multiple aspects within this, otherwise. In fact, I was actually planning to take this up while we move to the fag end of the presentation. But since you've raised this point, the idea is one, if say, for example, there is some investment which comes in, let's say from a family or a friend, and they take a particular stake in your entity. Let's say some 50 lakhs is invested by someone and they get about 5%. Suddenly the value of your company shoots up to X number. You take that as a benchmark and then you try and sell it off to someone else and so on and so forth. So the idea is that concept or validation, or for that matter, let's say IP, there's a very, very big difference between value and price. Someone willing to bet on your concept and your inherent value of that concept are two different things. The idea is that in the entire startup world, these two words are interchangeably used, which is price and value, which is not how it ideally should be. Fair value would be the intrinsic value or the genuine business cash flow producing capability of the business or the enterprise. Whereas price is when someone is looking at this from a perspective of investment from a 3 or 5 year horizon period and looking at an exit from a 5 year or 6 year or 7 year period, at that point in time, they'd be ready to pay a different price for it. So as I start, I will take up this entire question in terms of what value is, how price is different from value, so on and so forth. And then I'll leave the floor open for discussion as and when you guys have questions.
Nitesh, as you rightly said, there are two aspects. One is actually the valuation, and what is the price one is actually willing to pay. In fact, I don't want to take the name of the companies. In fact, there are some leading companies. Today, they are in the doldrums because they have excessively paid the money than what is worth of the valuation.
Absolutely.
Some of the people who are in the market, they know which company I am referring to actually. In fact, it has happened because, it is the negotiation skill of the person to persuade what is more worth than what he is really is. So ultimately, when you pay the very higher price than what is worth, when you start running the business, you face the consequences. That is what is faced by many of the organizations today. One of the leading organizations facing that trouble today, actually it is. So really speaking, it has got the very much intrinsic, as rightly you said, the valuation is something different. The price willing to pay or price willing to buy is something different here. That has to be very well distinguished in having into regard on what is the future, what is the future plan, where we want to go, where we want. So are we really worth in taking this business, or is the business really worth of the valuation? That is the crux of the matter one has to decide.
Absolutely.
Can we
Should we start?
Yeah,
We can
sure.
start.
Yeah, we'll start the presentation now.
Sure, sir.
Yeah.
Okay. Great. So I think my screen is visible now. And
very much.
We can
Yeah.
move ahead. So the idea is that I'm going to take you whenever we are starting a new topic or whenever I'm addressing a new problem. Essentially, what I try to do with respect to a new topic is that I try to answer 3 questions. Those 3 questions are what, why, and how. The idea is if you have answers to these 3 questions with respect to any topic, you essentially understand the topic really well. And then in all likelihood, you'll be able to explain the topic further as well. So the basic idea, basic premises, we try and answer these 3 questions today as to what is valuation, why do we need valuation, how do we actually go about doing valuation. And then obviously, while we go ahead and maneuver the methodologies in terms of valuation, we also discuss all the practical aspects because I've done more than about 200, 300 evaluations in the last 4-5 years. So I'll bring in a lot of practical experience in terms of what are the nitty-gritties and what are the factors that essentially you should be looking at, what are the red flags, and so on and so forth. Okay, so let me start. So the idea is whenever I ask this particular question, and I'll leave the floor open to you guys as well, whenever you have any questions or if you have an input, everyone who's listening to this, you can just type in the chat box and that will just make this pretty interactive. So the idea is whenever I start valuation at the topic, I ask this first question as to what do you mean by value? Because value lies in the eyes of the beholder, right? That's the phrase that has always been given. But essentially, if I'm looking at value, and if you genuinely want to understand from a layman's standpoint that what is value, the answer typically that I get is that value is nothing but the worth of something. That's about it. And if I want to better it from a financial standpoint, what am I looking at is value is nothing but the economic worth or the monetary worth. Often it could be of an asset, it could be of a liability, it could be of a business, it could be of equity, whatever. But the idea is, or the underlying is that it's the worth, right? A simple question could be, a lot of you might be owning iPhones. I've nothing against the company, but they're priced at 1,50,000 and 1,75,000. Now that's the price. I'm not sure whether that's the value or that's the value that you're getting. Some of them could be getting an excess value. Like say, for example, if I'm looking at a social media influencer and a social media influencer actually buying an iPhone to use or create content, could be getting value which is far higher than the price that they paid. Some of you might just be using the basic functionality of calling, messaging, and WhatsApp, which is available even in a 20,000 phone. Then you need to answer the question as to what is value and what's the price that you paid for that value, right? But one sense to differentiate, or if I have to take an example, differentiate between what value and what price is. So let's go back and let's say that we are sitting in March 2020 and this is the advent of the pandemic. The pandemic has just struck in and no one has any idea about what's going on or what's the cure or what do we do in such scenarios. And let's say one elderly gentleman, unfortunately, because of because of someone else's mistake, actually contracts this particular virus and had to be taken to the hospital immediately, isolated. And if you remember early days of the pandemic, the hospital bills were running into lakhs because no one had any idea and no one wanted to take chances. So let's say that this elderly gentleman was there in the hospital for a couple of days, let's say about 15, 20 days, and the bill came up to about 20, 25 lakhs, say hypothetically. Now, the idea is that this elderly gentleman doesn't have that kind of liquid money, neither does he have an insurance. So how do I go about paying this particular sum of money that the hospital has asked me for? Then he essentially realizes that the only asset that he owns is, let's say, a house property. And the house property, when he had valued it some 2-3 years back, because he was planning to sell it, let's say at that point in time, the value of that house property hypothetically was 1 CR. Now, if a pandemic is struck in and there's a lot of uncertainty, what will happen to the buyers? There would be very less buyers, correct? If there are lesser buyers, then essentially what happens to the value? Value essentially goes down. So let's say that the property price, which was 1 crore 2 or 3 years back, now when he's trying to value it during the pandemic because there are no real buyers, let's say that the value becomes 90 odd lakhs. And while he's looking to liquidate this particular property, he finds someone who wants to purchase this. But that person realizes that there is an added emergency to this entire transaction and kind of uses his negotiating capability to ensure that the final transaction gets consummated only at about 75 odd lakhs. What does that mean? Does that mean that the value of the house property is now 75 lakhs? Not really. Value of the house property is still 90. But the price which it was paid for is 75. So you need to understand that there's a difference between price and value. Value is the worth. Price is what you pay for that. Price will depend on a lot of factors. It will depend on external environment, geopolitical situations, industry, say, for example, your motivation, what do you intend to do, succession planning, negotiating capability, so on and so forth. So the idea is that there has to be one clear distinction. Unfortunately, the press has taken up this word that this is value. If we replace this word value to price, a lot of stuff will start making more sense than what it is right now. Okay. Second, this was an example where value was higher, let's say, than the price that was paid. Let's say I go back to the early 2013, 2014s, and let's say we have a new kid on the block, let's say Byju's, all right? And there's one sector in India which will never see a downturn, irrespective of whatever the economy is education, because that's how we are as far as the psyche is concerned, right? Every parent would want to ensure that the best of the education is available to the next generation to ensure that the future is secure. And people understand that, and they realize that technology embedded with education and reaching the scale that it ideally was not able to reach earlier could be the next big thing. Assume that you're studying in 2013, 2014, and let's say you have a proposal in terms of Byju's in front of you. You realize that, okay, this is one new kid on the block, and there's a huge potential with respect to what is there in the business. Now, if I'm looking at this potential, what am I ideally going to look at is the fact that how fast this can scale, what is the reach? Because understand that if there's one professor giving one session, he can only reach about 60 students. But if I insert or embed tech into this, this 60 can become 60,000 at the same point in time. So do you understand that the entire dynamics and the economics of things change? And obviously, because we have the kind of tech that is available now, things are changing as well. And that's why edutech had the kind of the interest that it generated over the last 6-7 years. It might be cooling off right now, but it's still, the story is still intact. So the idea is, let's say that when Byju's went with their information memorandum and 2013, 2014, hypothetically, and let's say that they said that we've done our calculations and we feel that our value is 10,000. But since you guys are getting a pie of this, we would like to get the transaction done at 12,000. Let's say that the investors agree as well. But at the same time, Byju's have another meeting with another investor, and another investor says that, oh, no, wait, I'm ready to offer you 14,000 for the same stake that you're looking at. Let's say another week down the line, they're meeting at another investor, they're offering 16,000, which is exactly what is happening in Shark Tank as well. Does that mean anything has changed on the ground level? Has Byju's hired anyone new? Has Byju's taken up any new? Nothing has happened. It's only and only what we call in our generation, which is FOMO, which is the fear of missing out. None of these investors wanted to miss out on the bus, because if they miss out on the bus, there's a high chance that, they would repent later on. I'll also explain you the psyche of the investor later at the fag end, and I'll make it really, really interesting as to how they look at investments and how failures don't really impact PE investors or VC investors. Okay. So again, value of Byju's at this point in time still remains 10,000 crores, but the price which is on offer could be 14, 15, 16, 17, or the final price which is negotiated at. So one thing I think it's very, very clearly established is the fact that value and price, two different aspects, and they should be treated as that, correct? Another thing that you have to remember with respect to value is also the element that value changes with time, right? A simple example could be let's say when the pandemic struck in, and we don't know, there's a lot of uncertainty in terms of when the theater halls will open up. At that point in time, a PVR or an Inox, the valuations might go down. But at the same time, for a company like Zoom, the platform that we're using right now, the valuations could skyrocket. Because the idea is that I don't think so anyone in India had at least heard of Zoom in the 2019s. No one. And now there's no one left in 2022 who's not heard of Zoom. I think people are just tired of the platform now in terms of the amount of time that they are spending doing these online meetings, right? So the idea is that value changes with time, and that is something that we need to understand very, very clearly. Okay. Also, if I'm looking at real estate as a sector, let's say a new law that comes in, value can also change when there is a new tech coming in, new law coming in, so on and so forth, because a lot of elements or parameters can change. So two things that you have to remember: value, price, two different concepts, and value will change with time. Always remember this. Okay. So that is one of the reasons why, there are a lot of times where people ask me that, is this valuation report valid for 6 months? Is this valuation report valid for 1 year? I tell them that there's no concept of validity from a standpoint of 6 months or 1 year. It's not even written anywhere in law. How we prepare balance sheets, and balance sheets are as on a particular date. Similarly, valuations are as on that date. If something goes wrong after that date, value can either drop or can fall. That is why you see all these market movements that you see with respect to all the listed entities. Otherwise, most of these listed entities should ideally have a standard rate. Correct? So
Now, when you say listed entities, it is a very glaring example, because in the morning when the market opens up, you suddenly see it is showing a very high price of the particular things. You think, oh, company is doing very well. But in the end of the day, if you see, suddenly the stocks falls down. But if people keep talking, oh, company performs well, the share price goes up, company doesn't perform well, the share price comes down. Do you mean to say the company performed well in the morning, in the evening it did not perform well? That
Not
is
really.
where the valuation comes actually.
Not really. So that's what I'm trying to say, that
Yeah.
that's why it's called the opening price and the closing price, right?
Correct.
So that's the whole element. They're not saying opening value and closing value.
Correct.
They're saying it's the opening price and the closing price with respect to the stock. And why? Because there are active buyers, active sellers who are deciding that this is what I'm looking at. Or again, even market from a standpoint, I don't think so. They take daily operations. What are they looking at is what is the immediate future? What the next quarter looks like, or what does the next 6 months look like? So on and so forth. Yeah. So essentially, I think it's very important to understand that value, price different, value also will change with time. So suddenly, say I'll give you a very simple example. Let's say when you see a spike in the price, not a 1% or a 2%, when I'm talking about a 10% jump in the price of a listed entity, when would this happen? You go back, and the example that I was talking about, let's say PVR or Inox, the minute it was announced by the state governments that theaters will open up, although at 50% capacity, but they will open up, the price is shot up with respect to these stocks. Why? Because that's the element. That's when there's some clarity that this will happen and the revenues will start coming in maybe from the next quarter or the next month or so on and so forth. Yeah. Okay. So now if this is what value is, why and where do we need valuation? So there are certain aspects which are regulatory in nature, and there are certain aspects which are non-regulatory in nature. I will discuss about the non-regulatory aspects first, and then I'll move towards what we call as the regulatory side of the story. Okay. Now, whenever I'm looking at non-regulatory aspects, what am I looking at? Say, for example, if I'm sitting with my company and I'm planning to take a strategic call, at that point in time, anything that I want to do, let's say if I want to have a new partner on board, or let's say, I need a new investor on board. Right? At that point in time, what I'm trying to do is I'm trying to evaluate internally. There's no compliance as of now, but I genuinely am trying to evaluate as to what should be the price or what should be the value. That's my starting point, and that I will be moving at the drawing board or the table. And then I'll kind of negotiate from the table and what I will arrive. So one could be for all the, the deal making and so on and so forth. Another aspect from a non-regulatory standpoint that we're looking at, which is getting very, very glaring day by day, is dispute resolution. So that's one area which is going crazy. Because what is happening is that a lot of these startup founders, they're in the 30s, 40s, young blood, very, very hot. And just yesterday, I think you saw that co-founder of Zomato has resigned and he's sent in a message stating good luck and Godspeed. So the idea is that there are a lot of friction. I'm not saying that it's healthy or it's bad. All I'm trying to say is there's a lot of friction when you are working in a high powered hustle kind of an environment. And at that point in time, this gives a lot of opportunity for disputes as well. And there are two entities which make a lot of money whenever there is a dispute. One are essentially the lawyers, and the other one are the financial intermediaries who are going to be helping figure out what is the loss, what's the value, so on and so forth. That's one area that I see in the next 10 to 15 years. If you actually specialize, valuation itself is a specialization, but if you specialize within valuation into dispute resolution, there's going to be an amazing practice line that you can take up for yourself. Another thing that I'm seeing coming up is that India has seen in the last 10, 15 years, India has seen a lot of first generation entrepreneurs. Right? And there's a lot of money that has been made in India, precisely. And what is going to happen is that when this generation moves on, there's going to be a lot of succession planning that is going to happen. Earlier, whenever we used to speak of succession planning, we would think of the Tatas, the Birlas, the Ambanis, thinking that, succession planning is only going to happen from the perspective of the bigger conglomerates. The idea now is that an average guy who was working, let's say, as a CEO or a CFO in a particular company has been given this wild instrument, which is called as ESOPs. And those guys, what they would have never made in their lifetime, have started making money in terms of crores, 50 crores, 100 crores worth of ESOPs. In fact, when I'd met Atul Bhai last month, we were discussing exactly the same thing, which happened with the entire team of Nykaa. When Nykaa got listed, we had new billionaires on the block, and they were all employees of Nykaa. Right. So the idea is that when this money is going to be passed on from one generation to the other, there's going to be a lot of succession planning that's going to go in. And also, all this money is not getting invested into the traditional avenues of fixed deposits. All right. And that's why you see that money is moving into the market. And from market, money is also moving into a lot of these startup avenues, because the IRRs which are expected in this industry are in the range of 30-40%, which means that your money is going to double almost every 3 years. That's the expectation. So succession planning, again, is going to become a very, very independently developed practice line within valuation, where you can see a lot of traction going ahead as well. Apart from that, valuations can be done just to understand where you are, whether you want to go for an IPO route, whether you know what your strategy is, just to understand and benchmark yourself where you are from a performance standpoint. It could just also work as a stick that, I intend to reach over here. I've just reached up till here, and so on and so forth. So those are certain non-regulatory aspects which you could look at. From a regulation standpoint, every time money that is going to come into India, or every time money is going to go out of India, there are FEMA, RBI regulations which are going to come in. And you have different entities depending upon what's happening. Either a cost accountant, a chartered accountant, or a merchant banker can sign off on those reports. So it requires valuation from FEMA perspective. There's another regulatory aspect, which is the income tax perspective, because there's a lot of gains, capital gains, which is going to happen. So from an income tax standpoint, whenever they are issuing shares or whenever you're transferring shares, and not only limited to shares, even if you are doing any instrument apart from equity shares, which could be convertible, preference, it could be anything else. Even at that point in time, you would require valuations coming in from standpoint. And obviously, while you're doing all these compliances, whenever there's an issue with a private company and you go ahead and do private placements and so on and so forth, you would require valuations under section 60s and so on and so forth. And that's where Section 247 came into being, wherein all valuations under Companies Act are to be done by a new entity, which is registered valuer, right? So under 62, you would require all your private placement related valuations.
There is a question has come actually on the validity of the valuation report.
Sure.
Saloni is asking, I encountered that when there was an issue of the share via private placement, professionals are stating that the validity of the valuation report is only 3 months. I understand that it should not be the case like that.
No. So exactly. So there's nothing like that. The validity of valuation report is 3 months. There's nothing like that. There's nothing written in the law also from that standpoint. So I think so. Yeah, as of now. So in fact, just to answer Saloni's question as well, say for example, it's a very right question and very rightfully asked as well. If say for example, there is a private placement that happens right now, okay, with that money, the company gets a new idea and they pivot in a month's time or 2 months' time, let's say, and they raise further funds because now they are going to take forward this particular idea to different geographies. You cannot use a 2-month-old report because valuations would have undergone a lot of change. That is exactly what I was explaining, that value changes with now. And that is why whenever, in fact, most of the valuation reports that you'd be looking at in the disclaimer section, you'll be seeing that they'll be writing one particular line, which is it's a very, very important critical line. It says that value is as on this date and not on any other date. Any change in the circumstances of the business after the date, the valuer is not responsible for the same. All right. So it's very, very clear that although they are stating that, it is valid for 3 months or 6 months, there's nothing like that. Valuation works exactly like balance sheet. If there is any change in debtor's position or creditor's position, the balance sheet changes the next day. Similarly, if there is any change, anything substantial, let's say even a simple thing like, let's say a CFO resigns. It's a big event. If a CFO resigns, then there's something right or something wrong that's going in, and you need to account for that as to what just happened. So the idea is that from a validity standpoint, there is no such concept that this is valid for 3 months or 6 months. Unofficially, there are a lot of talk that, this is valid for 3 months or 6 months, nothing on the paper, nothing on law. And frankly speaking, nothing even from a concept standpoint. Yeah. So
there is another question is actually asked, what is the case for an unlisted company where the promoters have actually created the software products on a platform and have actually passed customers across business vertical how does that one proceed?
I think I'll just try to read that question once again. What is the case? It's not very clear. The promoters have created a software product on a platform and have marquee customers across business verticals. Yeah, so then essentially what we're looking at is we'll have to draw down the projections with respect to this. And if there is a high growth which is expected in these projections, we might want to build in as well. So we might want to study what is the software, what is the applicability of the software, is there any change in tech which is going to impact this, whether a going concern assumption can be adopted over here, and then eventually try and see what the projections would look like. Also, apart from projections, we'll also have to take into account what kind of risk is involved in terms of whatever projections have been done, apply a discounting rate which is relevant to that, and then get to the valuation. The valuation methodology would more or less remain the same. The assumptions in terms of what the revenue growth could be like, or what could be the acceptability of the product, and all of that could be under consideration.
That's why keeping working papers or what papers you have worked, it's very important.
Absolutely.
There's one more thing has come.
Sure.
Is it required valuation certificate and change in type of the fully convertible, non-convertible preference share to optionally convertible, non-cumulative preference shares?
What essentially would you be valuing in this case? Is my question in the first place. Because you're just changing the type of the security. So are you trying to value the underlying equity, or you want to value these shares?
Rakesh, you are there? Can we hear from you, Rakesh?
Bala sir, are you allowed to do it? That's the first question.
Yeah, that exactly. Like, in fact, I'm even surprised that whether something
you're not allowed to do it.
No, I don't know. We will ask him what is actually in his mind. If he's there, we can ask him. Rakesh, are you there?
Okay, since he's raised the question on CCPS, even while you are, let's say if you're issuing CCPS, I'll first try and address the basics of CCPS for everyone who's coming in. Cable by saying that we can take the question at the end of the presentation.
Okay.
Point noted, sir. Point noted. But I'll just finish this. If you're issuing CCPS, even at that point in time, essentially CCPS, the underlying for those CCPS are nothing but equity shares for the first time, right? So essentially what you're trying to value is the equity, and you're valuing the equity shares only. It's just that you will be applying a conversion ratio on the basis of whatever valuation has been derived using the value effect. Yeah. Okay. So going back to the presentation, if I'm looking at it from another regulation, then I'm also looking at it from a SEBI standpoint, wherein we have all these alternative investment funds which have come into play. And AIFs also require valuations on a 6-monthly basis, coming in from an independent valuer as far as their regulations are concerned as of now. That's where valuations will come in. And then we have different elements, say, for example, if there is a merger or an acquisition, for a merger demerger process, you would need it. You might need valuation of intangibles from a purchase price allocation standpoint. You might need valuations of ESOPs, because ESOPs is a pretty big cost, In fact, if you see some of the bigger corporates, they've started reporting EBITDA prior to ESOP hit and EBITDA post the ESOP hit as well, because the amount of ESOP hit that they are taking is phenomenal. So these are certain areas where valuation is going to typically apply. And as I said, we can bifurcate this into regulatory and non-regulatory. Well, as I keep on saying across forums, the idea is that valuation itself is a specialization, but if you actually go ahead and do a specialization within valuation, there are various fields which you could do that, and you can make a career out of it. All right. Moving forward, which is the most important aspect, how do we go about doing the valuation? So even before we jump in, there are certain basic aspects which you will have to keep in mind, certain preliminary information that you'll have to keep in mind to do any sort of valuation. The first thing that you need to ask yourself is, why are you doing this valuation? If the valuation is from a regulatory standpoint, then there is all likelihood that valuation will be from a fair value perspective. Okay. If a valuation is from a seller standpoint, a seller just wants to stand a particular or sell a particular asset of value or a company or a particular business, then at that point in time, that valuation might not really be from a fair value standpoint. They might be looking at it from a seller's perspective. So there, the entire premise of valuation changes from fair value to, let's say, seller's value. So purpose or value is also very, very important. Once you establish the purpose, whether you want to do fair valuation, whether there's going concern or not, whether you want to do seller's valuation, next thing that you ideally move on towards is, when do you want to value all of this? Because that is what we've been discussing, that valuation changes with time. So the next important thing that I want you guys, everyone to focus on is, what is the valuation date? Because I've seen certain valuation reports historically in the past, wherein the entire report, there is no valuation date which is mentioned. The only thing that is there is the date on which the report has been signed. And it is assumed that whenever this report has been signed, or whatever date the report has been signed, is the date of valuation. So it's very, very important that you establish a particular date as to at what date you want to value. Once these two preliminary aspects are taken care of, then you start collating data, because there's a lot of analysis that is going to go in while you go ahead and do your valuation as an exercise. And there are two components that I generally list down. One is start collating data from an industry standpoint. And second that I want you to do is start collating data from the company standpoint. Now, when I'm looking at this from an industry standpoint, I'm looking at all macro factors. Okay. So what is the economy looking like? What is that particular sector looking like? What is the past in terms of that sector? So on and so forth. Now, the question could be, where would we get all these kind of data? So I'll very quickly run you through the sources where you essentially can get data from an industry standpoint. And what you can do is, if you're looking at anything which is macro in nature, just look at the last thing which is there on the slide. You can log on to World Bank's database. World Bank's database, the data book that is there on the database, has data of more than 188 countries. Okay. And also you will find a lot of data that's available from a historical standpoint. So you will have a lot of data to analyze, to check out your trends, to understand what could be expected, to draw down your correlations, and so on and so forth. So from a global standpoint, go and check out the World Bank database. Second, from a domestic standpoint, if you're looking at India, then you can either log on to MOSPI or you can log into CSO, or the Central Statistical Organization, or the office, wherein you will get a lot of data with respect to what is happening in the Indian industry and so on and so forth. Once you're done from a macro standpoint and you want to move towards the industry standpoint, what you can do is always remember that any industry will either have a regulator or will have an industry body. When I'm saying they will either have a regulator or will have an industry body, what I'm trying to say is, let's say if I'm looking at automobile doesn't really have a regulator in India, but they have something called as SIAM, which is Society for Indian Automobile Manufacturers. Okay. And if you log on to the website of SIAM, it's such an amazing website that you get every data or data point with respect to what's the production statistics in terms of, let's say, four-wheelers, what are the sales statistics from four-wheelers, what is the capacity that is there in the country, and so on and so forth. You will be surprised. There are a lot of times that, sure. So you could essentially be looking at all of this data in fact, there are a lot of times where I get this question that, oh, there's a lack of data. But I think one thing that I've realized is there's lack of time. Because what happens is that the client comes in and says that, oh, I need a valuation. You ask him, how much time do I have for this assignment? The client will tell you, oh, yesterday is what I was expecting this valuation report. And then they'll say, no, 2-3 days if you can do it. You have to understand that you cannot actually go about doing valuations in 2 days or 3 days time. A simple valuation, even a simple business valuation, should at least take you 8 to 10 days just analyzing and seeing, because there are a lot of aspects which are at play and you need to correlate all of these aspects. Okay. So these are your data points with respect to industry. If, say, for example, you do not get any data from either the regulator or the industry body, then you can log on to research reports which come in from the credit rating agencies, or you can log on to research software, which I've mentioned over here. When they'll be circulating the software, you will have all of this data as well. So collating data, I'll go back. Collating data is very, very critical. You have to collate data from two perspectives. One would be the macro and the industry data. The second would be the company related data. Now, when I'm talking about the company related data, again, you'll have to, there are two subparts to this. You'll have to understand what are the business drivers, what are the cost drivers, what are the revenue drivers, what are the working capital drivers, what are the capex drivers with respect to the company. You'll also have to figure out what are the historical financials of the company to understand as to what they have done in the past. And then you would also require what is expected out of the company in terms of the future. Right? So from a company standpoint, you would require historical data as well as projected data. And then once you have all of this data, we'll try and understand what kind of approach that we want to use for valuing this particular entity, and then we'll move ahead. Okay. So while we are doing this, there are essentially three approaches to do valuation. Okay. And when we are talking about approaches to valuation, whether you're doing this valuation in India, US, Australia, wherever, whatever part geography in the world, there are three approaches with respect to the valuation standpoint. There could be various methodologies, which could be a part of these approaches. But while I look at the core approaches, we have three approaches. They're called as the income approach, market approach, and cost approach. And what I'm essentially going to start off with is the income approach side of the story. Very, very interesting and very important. So hear me out for the next half an hour, very with the full attention. Okay. So essentially, when I'm looking at income approach as my starting point, what this approach talks about is what is your business's cash flow generating capability in the future, which basically means that they are looking at the inherent cash flows that your business can generate. You know, I have this one very famous line, which I always look forward to, which says that top line is vanity, bottom line is sanity, but cash flow is reality. And most of the traditional Indian businesses would tell you that this is how businesses should be run. They are going bonkers, all right. If I talk to my father's generation and tell them that, you know, people are putting money into businesses which are generating losses, he doesn't understand this concept, right? And when they talk amongst their friends as well, they don't really understand. And most of these are from business families, and they still don't understand this concept as to how this is working and how long would this work. So the idea is that from the income approach side of the story, you are essentially going to be predicting the future. So you are stepping into the shoes of the Almighty. You get the opportunity to predict the future, and once you predicted the future, depending on the risks that the future holds, you need to discount these cash flows back to present value. That is essentially the income approach. Right? So what am I doing? Again, I'm repeating income approach. What I'm trying to say is that wherever the company stands today, from now on, how much money can the company generate over its lifetime? And since this money is going to be generated in future and value of ₹1 is not going to remain the same in the future, I need to discount these cash flows back to present value. All right. So that's what I'm looking at from an income approach standpoint. We'll discuss more in detail with respect to income approach as well. Next approach, which I'm looking at, is the market approach standpoint. Now, market approach is something that we've learned since the time we were in school, right? Human lives are incomplete without comparison. We are comparing at all points in time. You know, all these social media influencers keep on telling us that comparing your life with someone else, it will only give you nightmares. But the idea is in valuation, it's very, very important that you do comparison, because you will try and understand as to where you stand and where the industry is pegging all other peers and all your comparables. So under market approach, what you try and do is that you try and derive the value of your company by looking at how the market is valuing your peers. All right, just understand the concept. We'll get into the methodologies later. So certain aspects which become very important over here is you will first require comparable companies or peer set, and then you will require some element which will help you compare their valuations and arrive at your valuation. Right. So that is what market approach essentially looks like. Market approach is also called as relative valuation because you're trying to get to the valuation by relating it to someone else's value. And lastly, if I'm looking at cost approach, this approach was very well explained in the web series which recently came out, which was Scam 1992, which was the entire Harshad Mehta case. And in one of the episodes, the protagonist was basically sitting in one of the company's boardroom and explaining the promoter that why are you looking at the value which is there on your books? Try and understand that the value is, if you had to create a company, what you have created as it is, as on today, what would be the value that you'll have to pay? And that is essentially the cost approach. That if you had to replace all assets, or if you had to replace every asset on the books that you have right now, what's the value? Because in all likelihood, a lot of traditional companies would have taken lands in the 60s and the 70s and the 80s. There's a high chance. Say, for example, if I want land as big as the Jamshedpur steel plant, you're not going to get that kind of land only anymore. So it's very, very critical that on the cost approach, you try and essentially figure out whether you will be able to get to these assets first. If yes, then what would be the value of these assets as on today? And on the basis of that, what's the revalued number that your entity should ideally be valued at? Okay, so these are the three approaches with respect to valuation. And let's get going into the process flows with respect to all these three approaches. We'll start with income. Under income, there are three important components or three important aspects. The first thing,
Nitesh bhai, before you move, so what if we go to the previous slides? So what I understand, it's more of a perceptions, you know. So you create a good perceptions, you know, where you think, look, you know, the this market is going to be like this, you know, and my cost is one of the lowest, and you know, this is how I'm going to be, you know, doing multiples, you know, of some incomes and top line or a bottom line. So now, see, I may think I have a different perceptions. Tomorrow, if I go to Mr. Bala, you know, he will have a different perceptions, you know. So what I'm trying to convey, how do you justify? So is there any benchmark or, I mean, because I believe, you know, there are some case laws, you know, are also there, you know, some judgment are also there about some wrong, you know, methodology or evaluations, you know, which has been given. Yeah, that's why.
Sure. So how do you justify is a very, very critical question in terms of how do you evaluate those projections. I have not seen a single, and I would have seen more than 1,000 projections in my life now, and I have never seen a single projection which says that the next year will not be good or a year after that will not be good. सबके projections में अच्छे ही दिन होते हैं, बुरे दिन होते ही नहीं है किसी के भी projections में. So that's point number one. So we'll have to take it with a pinch of salt that these projections, because they are made on Excel, and converting Excel into reality are two different things. So now it is very critical for you to analyze whether the projections which have been given to you or the projections that you are making, do they stand the test of reasonability? We call it the stand of reasonability in our firm back. What do we do is, as far as our working papers are concerned, we highlight all the revenue drivers, the cost drivers, the working capital drivers, the capex drivers, which are the four important constituents of any business. And we try and see whether these elements are making sense or not. A simple example could be, say, the projected growth in one of the projections that you're looking at. Let's say if I'm trying to value a newspaper company, let's say I'm trying to value Times of India. And let's say that the projected growth that Times of India has shown in the revenue or in the top line for the next couple of years is 20% or 15%, 10%, and so on and so forth. And I personally know that, you know, I have data points which says that the industry is actually going to degrow. Forget growth. It's going to degrow because newspapers technically a dying industry, radio technically a dying industry. At that point in time, it is very important for you to question whether these projections can happen or not. And you've raised a very valid point. These questions, I think, came up with the administrators and everyone who's sitting in the think tank as well. And that's where the valuers now, under IBBI, the registered valuers, they're supposed to write in their report that they have tested the projections that have been provided to them on the basis of reasonability. Because there is some element of responsibility also being assigned to the valuer. You can't just say that, oh, the projections were given to me, I accepted those projections and I have built a valuation on the basis of that. No more the case. And that is where, you know, a good valuer and a great valuer are going to be distinguished. So it's all about understanding whether you practically know that newspaper is a dying industry. Times of India cannot grow at 20 or 10. But if you go ahead and sign on those projections, you're essentially, you know, trying to give a wrong kind of a projection to whosoever is the reader of that particular report. So it's important that you do something called a test of reasonability. And while you do these tests of reasonability, because you asked this question, one, do it on the top line growth. First, the top line growth. Why is that is critical? Because that's your North Star. Okay. One, whether is the industry expected to grow at the rate at which you are growing? If that is not going to happen and you have projected a growth, it means that you are going to capture a market share which you've never seen or someone in the industry might have never seen. So it's very important that you kind of tackle that. Second thing, in most of the projections that I see is that suddenly EBITDA margins, which were 10%, 12%, whatever, will suddenly become 25%, 30%. They think that, they will become profitable and so on and so forth. Cannot happen overnight. I had this one argument with one of the clients, where historically their projections were in the range of 12%, 15% EBITDA margins. And the projected year, someone would have told them that, if you are making 5-6 years of projections, then if you increase your projections, the EBITDA margins for the last couple of years, the value might go up. They showed, or they estimated EBITDA margins to the tune of 30%. I told them, let's just delay the valuation for 6 months. Let's see in the next 6 months if you can get to forget 30%, if your EBITDA margins can even go up till 25. I'll be willing to sign off on this 30%. Next day, I got revised projections with 16% and 15% of EBITDA margins, because they understand that all of this is not going to happen. So it's very important that you just cannot accept projections as it is. You will have to see whether these numbers, if I'm talking about EBITDA margins, whether historically EBITDA margins have been achieved at this level. If no, it's a red flag. Then try and see what is changing. So say, for example, if I'm looking at Maruti as an industry or auto as an industry right now, and auto as an industry is undergoing a sea change because we are going to move from petrol and diesel to maybe electronic, or maybe going forward to hydrogen when we have laws with respect to that, you will see that the margins will change drastically. Because for a petrol or diesel car, manufacturing cost could be very different vis-a-vis manufacturing cost for a EV car. If something of that sort is happening and the margins are changing, fair and valid. But if margins are changing without any change in technology, without any change in cost of production, and just estimated that cost is going to go down, then these are all questions that you really need to ask and put it down in working papers as to why this is happening. Right. So, one, revenue. Second, go and check from an EBITDA standpoint. Another important consideration is in the projections is also the working capital cycle. A lot of people don't understand that from a working capital standpoint, businesses can make money out of just working capital. Right. I'll give you a very simple example. I was valuing one of the cab aggregators some 2 years back. And this cab aggregator told me, it's a pretty big cab aggregator based out of Goa. And they told me that, why did I not raise funds 2 years or 3 years back? Was because I got an idea that if anyone wants to book a cab, essentially I want them to book a cab via my wallet and not anything else. So what he did was he created a wallet, and he said that the minimum amount that has to be there in this wallet at any given point in time for you to do a booking is, let's say, 200 rupees. So essentially what he did was, he got 200 rupees from every customer, and that money is lying in the kitty. Not necessarily everyone is using that 200 rupees at the same time, which means that he's got a float of 200 rupees from every customer that he's created. And he's created a negative working capital cycle. And if you can create a negative working capital cycle, essentially what you're trying to say is that you're going to be working on someone else's money. Right? Let's say if I'm looking at Maruti's working capital, Maruti will not have any debtors. Maruti will not have, simply because you will not be allowed to take, assuming that all the showrooms belong to Maruti, you will not have any debtors, for the simple reason that Maruti will not allow you to take a car out of the showroom unless and until either you have paid the money or someone else, which is the bank or the financial intermediary, has paid the money, which means that they will not have debtors. They could have some amount of inventory depending upon whether the model is hit or bad. And from a creditor standpoint, they can always ask the vendors, because I am the leading as far as the market share is concerned, I have 50% market share. So if you want to do business with me, my terms are 45 days of payment. The guys who are supplying, let's say maybe steel or maybe supplying glass or maybe paint, would happily go ahead, because they know that 50% of the market share is a very big number and which will impact their top line. So it's very, very critical that even from a working capital standpoint, you evaluate businesses and whether working capital can change overnight or not. So
you are absolutely right. In many companies, what they do is they make the collection is quicker and the payment is later. Because you say my terms are like that. You know to pay me within 15 days. But whereas I try to pay my suppliers only after about 90 days.
That's negative working capital, sir.
That's negative working capital cycle, which is very good from a business cash flow standpoint. All right. It might not be great from, let's say, your image standpoint. It might impact the image to a certain extent, but from a cash flow standpoint or from the expertise of running a business, that's a fabulous way to run a business. Right.
All because people will not be so lucky also.
Yeah. So again, it all depends on industry to industry as well. Now, just think about this. I'll give you a prime example. education was supposed to be non-profit in our country. But education is actually sold on two things. One is the fear, which is the fear of the future. And the second thing is, have you ever paid fees anywhere after completing the course? Never. All fees for all education institutions are always paid in advance, which means that they never have a working capital problem. Which essentially means that if you ever see any educational institution going for a loan, you have to be really, really worried. Because why do they need funds? Okay. So it's very critical for us to understand that from a business standpoint, valuation standpoint or business standpoint, revenue top line has to be taken care of. Your EBITDA margins have to be taken care of. Your working capital has to be taken care of. And lastly, the fixed asset turnover ratio or the capital expenditure should also make sense. What I've seen is people project that, my turnover is going to increase, my margins are going to increase, but they don't increase or estimate the increase in terms of what is the capacity that is going to be required to get to this. And what happens because of this is, at times, if you actually try and evaluate certain projections, you'll understand that if this is the capital expenditure that is there in the company, you might be running at 130 and 140% of the capacity, which cannot happen. So as just to complete and conclude Atul's question is that reasonability testing for every projection is very, very critical. And that is where the expertise of a valuer comes in. Otherwise, what is a valuer there for? Then it is just a simple mathematical exercise. You just put in certain numbers, the templates are ready, and you can get an answer. The entire idea of a valuer being there is to understand, analyze whether all of this is possible on an as is where is basis, and then try and come up with their observations and comments. Yeah.
Someone is asking, valuation of the intangibles, IP, are not so easy. How do we actually do it?
So valuation of intangibles are not really complicated as well. I think it's one of the fields where there's not a lot of awareness. And frankly speaking, I think there's going to be awareness which will come into play with respect to these intangibles also in the future. The approaches, even for valuing intangibles, remain the same. It's income, market, and cost. But depending upon the intangible, the methodology would differ. So if, say, for example, I was trying to value a brand, okay, to value a brand, I would go ahead and use income approach as my approach. And the methodology could be something called as relief from royalty. So what goes in is, say, for example, you want to value this brand Raymond, okay? And let's say that you do not have ownership of brand Raymond, okay? You want to value this brand Raymond and you do not have ownership with respect to this. So essentially what you're going to do is, you are going to be licensing this brand from whosoever the owner is. And eventually you'll end up paying royalty to the owner. So the idea is, the methodology talks about the fact that since you are the owner of this brand, and since you are not supposed to pay any royalty to anyone, there's a lot of savings that you're doing from a royalty standpoint. You take the cumulative value of all these royalty savings that you're doing throughout the life, that will be the value of brand. Okay. There are multiple methods for other intangibles. We have methods such as multi-period excess earnings. There's for, if you want to value non-compete agreements, we have something called as with or without, so on and so forth. Okay. Maybe we can schedule one session on valuation of intangibles also sometime.
That's a topic by itself.
Yeah, it's absolutely a topic by itself. There's no doubt about it.
Someone is asking, how do we ensure that our valuation is actually reliable?
So this is exactly what I was explaining, right? All your valuations have to have reasonability testing done. You cannot rely on the projections that have come in, because you have to understand that projections will always be rosy. Someone is making this on Excel file. Making things on an Excel file is far easier than executing it in real life. Okay, it's only people who have Atul Bhai would know, he's run a marathon of about 25-30 years with his firm. Ask him for the initial years, and then you'll see the light comes in only at the end, or the fag end, That's how difficult it is. But if I was actually making the projections, I can always go ahead and make projections. 5 years down the line, I will, I'll have so many partners, I'll have this kind of a firm, and so on and so forth. But when you actually go and sit on a daily basis, you will see, you're sitting, it's not easy. You're sitting on thorns, on a daily basis. You're firefighting. You get up in the morning, you see where the fire is, douse the fire and go back to bed. That is essentially what you do. So I think reasonability testing is very, very critical. Also, when I come to market approach, I'll explain you what we do in market approach as well, so that the testing part or the reliability part gets answered there also.
Can a client appoint multiple valuers for the same date?
Absolutely. And whenever the client will appoint multiple valuers, and if the valuers haven't spoken to each other, they will never come with the same value. I can guarantee, I can sign off on that.
200%.
Okay. Unless and until they've spoken, if they've spoken to each other, then they might come to the same value. But if they have not, you will never be able to get to same valuation.
What are the do's and don'ts in the valuation?
Sure. So this do's and don'ts are very, very critical. Okay. So the first thing that you should do from a valuation standpoint, never value from a desktop basis. They have given you something, you are sitting in your office and doing a valuation, never do it. Go to their offices, go and check what are their plans, what are their businesses. If it's a service business, try and understand, use those services. I was valuing a social media company recently, and at that point in time, they gave us all hunky-dory projections and all. So we told them, all that is great. Since your entire product is still in the beta stage, we want to use that product. Give us access to all our employees. We'll be using it for a couple of days to understand the interface. And you will not believe, the entire perception changed. If I would have just done a valuation on the basis of the numbers that that company had sent, the value that came in would be very, very different from what the value that I got after I experienced the product, because the user interface was not that great. Things were not moving. We were not able to upload videos and so on and so forth. So that's where we understood that, they said that we'll start, the beta stage will get done now, and we'll start, let's say, our revenues will start coming in 2023. We realized that they are at least a year and a half away. So I don't think so the revenue is coming from them in 24 or 25 also. So that's where we moved their projections from 22 or 23 to 24, 25. And that's when reality came in. So the do's all part is, you should always try the product or the service out first for yourself to understand whether genuinely kuch value hai kya product. All right. So if you remember, even while we were doing Shark Tank, they had half an hour. Everyone used to get their products just to see what those products are, just to have a touch, look, feel, and so on and so forth. Unfortunately, what is happening right now in the industry is that a lot of valuers are just doing desktop valuations. What I mean by desktop valuations is that they get certain information from the client without visiting the client, without talking to the client. They just run up certain numbers and they come up with a value. And obviously, if you have 2 days or 3 days worth of time, you are going to be doing that. So I think once the industry evolves, and I think we are in that stage where the industry will evolve, where our valuations will evolve, our reporting will also evolve. At that point in time, you will start seeing that, valuations will have far more reliability than, let's say, what valuations have today. And I think everyone is still in the learning stage. Not only are valuers who are learning, the regulators are also learning simultaneously when values are learning. So it's going to be an interesting time, maybe the next decade or so for this.
Could we get an example of how to set a valuation date in case of a startup entity trying to pitch in for the investment, showing future projection for say about 5 years?
Yeah, so there is no need to get to an estimate. The idea is, say, for example, if I am evaluating any startup and I'm looking at it from an investment standpoint, I can always take the last month's closing because I will have my accounts taken care of up till last month's closing. So just to give an example, if I was looking at an investment today and I'm trying to get this for a startup, I will tell them that the date of valuation could be 31st of October. Because I should have all your accounts and all your invoices and all your documentation up till 31st October sometime. And then we can go ahead and do valuation on 31st November.
In case of the multiple appointment of the valuation, there is a question has come. In such a circumstances, we both come out with a wide variance in whose report is to be adopted.
So, that's where the valuation ka beauty comes into play. I don't know whether you guys follow IPOs or not, but if you follow IPOs, you'll be aware of something called as the floor and the cap. And the floor and the cap, the difference that is allowable is 20%, correct? So that is why valuation always will be range bound. So rather than looking at value from a 1 point or a single point in number, try to look at value from a range perspective. And that's when you will not go wrong. So you might not get the exact same value from two values, but you might get valuation which is range bound, right? And then you might want to rely on that particular range. So what I'm trying to say is, let's say value from one valuer came up to 110 crores and another valuer came up to 102 crores. But essentially what I'm trying to say is that the range for this particular business could be 100 to 120 crores. And that is what you should be relying on.
I think probably someone is also trying to make a comment that way only. it cannot have the wide variance if all factors are considered it properly. If at all there is a wide variation, then it could be discussed with the reason.
Yeah, so at that, if there's a very, very if the numbers are very, very different, then you might want to study the reports and try and understand that, you know, if there's an error in the computation and so on and so forth, but at least they should be range bound is what you're looking at. Yeah. Okay. So getting into the income approach, there are three things which are very, very critical from an income approach standpoint. I'm not going to get into the technicalities, but at least because you'll be reading this report, so you should be able to read those reports. Let's say if I'm looking at income approach, the first thing that you will have to look at is the projections. Do not accept the projections as it is. In fact, take it with a pinch of salt, because whatever projections that you're going to look at will always be very, very rosy. Because you're never going to see projections which will say, oh, I'm going to have a degrowth in the next year. It's not going to happen. The only time that happened was during the COVID year, because everyone knew that, okay, now in COVID, no one is going to make the revenues that they were estimating. So first thing, projections, very, very important. You will have to spend a lot of time understanding projections, analyzing projections. I've explained what all areas or aspects that you can look for in those projections. Second thing that is very, very critical is you cannot keep on projecting for eternity. All right. So those projections also have to be made for a particular period. And one standard practice that I've seen in India is everyone makes projections for 5 years. I don't understand why do you make it for 5 years? So projections also not necessary that you're supposed to make it for 5 years. There's no standard rule, no written law that you're supposed to make it for 5 years. Okay. The idea is that you have to understand when does the business become stable. If the business is like a HUL or a PNG and it's a stable business, let's say growing at 6-7%, you can just draw down on the next year or 2 years of projections and you are done because the business is stable. If the business is a startup, then not necessarily you're supposed to do it in 3 years or 4 years, 5 years. You might require a 7-year projection because the first 2-3 years, the startup would be concentrating on the top line. The next 2-3 years, the startup would be concentrating, let's say, on the EBITDA margins. And finally, in the next 2-3 years, the startup would become stable. So the idea is that your projections need not be for 5 years, 4 years. There's no standard rule. It will depend on the life cycle of your company. If the company is stable, you don't need 5 years of projections. If the company is high growth, you might require 3, 4, 5 years of high growth and then stable growth. If the company is a startup, then you might want a 3-stage model. So depending on where your company is what you should be making those projections or the number of years of projections for. Okay. So since the company, you cannot project for eternity, there is something called as terminal value, which becomes very, very critical. Okay. And what happens under terminal value is you try and determine the value of the business as on that date. So let's say, for example, you made projections for 7 years. And after 7 years, you are saying that at the end of 7th year, what would be the value of the company? So there are two approaches over here. You can either use an exit multiplier or you can use a Gordon growth model. When you get some time later, maybe, we can get into technicalities. But the idea is that you try to derive the value as on that date. So you have 2 sets of cash flows which will come to you. One set of cash flows are for that 7-year period that you projected for. And the second set of cash flows is for the business that it's going to generate for eternity, which we call it as terminal value. And the last important aspect under income approach is since all these cash flows are accruing in the future and all of this you'll have to present value, you will require something called the discounting factor. And essentially a discounting factor that you generally use, if you are using a FCFF methodology, then you use weighted average cost of capital. If you are using, let's say, free cash flows to equity, then you go ahead and use cost of equity as your discounting factor. So 3 things, you would require the projections, you would need to understand the value of eternity, and you would require the discounting factor to discount all these cash flows back to present value. Yeah. That's income approach for you. Everything that I spoke about, understand business plan, historical performance, regulatory trends, all of this are a part of your income approach. Coming to market, 3 things which were important under income approach. There are 3 things which are important under market approach as well. The first thing that is important under market approach is you will have to identify comparables because you're trying to relate your value to someone else. So say, for example, if I was trying to value Tata Motors, comparable for me could be Ashok Leyland. Or if I was trying to value Tata Steel, comparable for me could be JSW Steel or SAIL. So I have to understand that whenever I'm doing market approach, the first element or the important consideration that I'll have to look at or I'll have to take is the fact that Does this company have any comparables? Yes or no? If the company has comparables, then we can go ahead and apply market approach evaluation. Again, market approach evaluation also has two methods. They are called CCM and CTM. CCM stands for comparable companies methodology, and CTM stands for comparable transactions methodology. What you do under CCM is, in CCM, you essentially have all your comparables which are listed on the bourses. And since they are listed on the bourses, you will have market prices and the valuations readily available. Under CTM, the companies might not be listed, they might be private companies, but a transaction would have taken place in those companies, and that is why you'll be able to get to the value of that company. Okay. So if I was, say, for example, if I take Tata Motors and I want to value Tata Motors, or let's say if I want to value Hyundai Motors India, Hyundai India is not listed, it's a private company. And if I want to value Hyundai India, then my comparable could be Maruti Suzuki. And I could use Maruti Suzuki or Tata Motors as my comparable and try and get to the value of Hyundai India. Similarly, this approach would be comparable companies. Why? Because Tata Motors is listed, Maruti Suzuki is listed. But if, say, for example, I wanted to value, let's say, Flipkart India. Now, Flipkart India obviously is not listed. And if I want to value using market approach, the comparable could be Amazon India, but Amazon India is also not listed. So the challenge is then I might want to look at private transactions that have taken place in the e-commerce space. And that's where transactions methodology will come into play and not comparable companies, because these companies are not listed. So that's the basic difference. Apart from that, the considerations remain the same. What you essentially try and do is, once you have the comparables, you try and figure out a financial indicator. In most cases, the traditional indicators or the traditional multiples that we have are price to earnings, price to book, EV to sales, and EV to EBITDA. These are four traditionally internationally accepted used valuation multiples that you will see across most industries. And then there could be certain industry specific multiples as well. But EV sales, EV EBITDA, price to earnings, and price to book are your four multiples that you will always see in one or the other reports that you'll be looking at. So essentially what you do is, say you are trying to value, I was saying we are trying to value Hyundai Motors India. You try and figure out what is the PE multiple, let's say for Maruti Suzuki, and we arrive at the PE multiple of 40. Now, let's say we know that our profitability or Hyundai's profitability is 1,000 crores. So you apply 40 to that 1,000 crores of profitability, and 40,000 crores is essentially what we are saying is the value of Hyundai Motors India from an equity standpoint. So apart from comparables, the next important thing would be you identify what is the multiple. And the third thing that will come into play is you adopt the multiple. Okay. So three things which are, Pranali has a question which says that do we select only one comparable? No, in fact, that would be a folly. The idea is you should select as many comparables as possible, so that you can get a good range and you can get to a mean or a median kind of a statistics as to what is the acceptable multiple that's going on in the industry. So the idea is not to look at just one comparable. It's just a hypothetical example. You should be looking at as many comparables as possible. But remember, those comparables have to be comparables from the perspective of business service line. They should be comparables from the perspective of geography that you're operating in. They should be comparables from the perspective of margins. And they should also be comparable from the perspective of the size of the company. Yeah. So that's essentially the market approach valuation. I'm not getting into details, but I'll just run you through one example. Let's say you are valuing this ABC Limited using CCM, and you have these four companies which are listed on the bourses, and you get to market capital, okay, which is nothing but market capitalization, which is market price per share multiplied by number of shares. And you get to the multiples of, can you just focus on the PE multiple? I'll just explain that. So let's say we get to the PE multiples for iShares, Ashok, Force, and SML. And we are saying that since iShares is actually an outlier, if you actually look at these multiples, iShares has multiples which are far higher than other comparable companies. Their EV sales multiple for iShares is at 8, EBITDA multiple is at 26, and PE multiple is at 40. Whereas if you look at other multiples, the EV sales multiple for Ashok, Force, and SML is turning out in the range of 1.5, 1.3. Essentially, what we are saying is that your enterprise value is 1.3 or 1.5 times the revenue. For iShares, it is turning out to be 8 times. At this point in time, you should try and identify why this is happening. Is iShares really an outlier? So if you go and study further, you'll realize that, oh, iShare has a monopoly in certain businesses, and that is why it commands a higher valuation. But your company,
motorcycles.
correct. So since you have a monopoly in a particular business, you're commanding that kind of traction in terms of valuation multiples. At that point in time, you should ask a question to yourself, whether the company that you're valuing, does it have any monopoly? If the answer is no, then you should eliminate iShare as a comparable. And that's what I've done in this example. You eliminate them and then take the remaining multiples and then apply it on your own parameters to get to the final valuation. All right. So that's your market approach. Under market approach, there are certain specific industries where you can use different multiples as well. If you're looking at hospitals, another multiple could be, apart from the 4 multiples that I spoke about, would be EV by the number of hospital beds which are available. If you're looking at hotels, then it could be the hotel rooms. If you're looking at mines, then what are the reserves that the mines has, and so on and so forth. If I'm looking at this from let's say, if I'm trying to value Ola or Uber, then I could have the car fleet that I have with the company that's available. Okay. So again, contemporary multiples could also come into play. So this is the income approach, market approach side of the story. And I'm going to discuss certain issues with respect to income and market going forward. And then we'll move to, or maybe I think first, let's finish cost approach as well. I'll just go to cost and we'll first try and close cost approach also. So under cost approach, there are 2 methodologies. One is called the replacement cost and the other one is called the reproduction cost. Reproduction cost is hardly used because the idea under reproduction cost is that you should be able to get to the cost of an exactly similar asset. So say, for example, if you have a steel plant, which was kind of incorporated, let's say 10 years back, and now there are technological changes and no one really manufactures that steel plant or that kind of a steel plant, then you are never going to get a reproduction cost. But what does the replacement cost say? That if you have a 1 million ton steel plant, what is the price of getting a 1 million ton steel plant today with the new technology, so on and so forth? And you apply all the replacement cost to all your assets and you get to a revalued balance sheet. And that number is what you should be looking at from a valuation standpoint. Yeah. So these are essentially the 3 approaches from a valuation standpoint. And just to give you an example, when to apply what approach is very, very critical. And as a valuer, you should have that knowledge base as well. So if I was trying to value a startup, what approach? And I want answers coming from your side. If I was valuing a startup with hardly any revenues or which has just started generating revenues, what approach will you guys apply from a valuation standpoint? Okay. I'm getting income as one of the answers. Okay. Anyone else? Anyone can just, I think, just switch on their mics also and talk if you guys want to talk.
So a company like Nykaa, probably I don't know, when they've started, they also must have taken a lot of money, from the private equity, Now it's all, selling online cosmetics, So I don't know, you already had Amazon and all, they sell virtual everything, on the website. So I don't know, only cosmetic and, that was also great valuation. That was something amazing. But of course, startup has its own valuation. If I'm starting any company, of course, I think my company's valuation is like this only. And probably tomorrow, Nitesh bhai says, look, it is different. Like this, I don't know.
Yeah. So Nykaa has a slightly different model from the Amazons, and so Nykaa works on the warehousing model. Nykaa actually stores all the inventory that it kind of. So in fact, if you go and see Nykaa's website, you will never see discounts to the tune of 50% or 40%. You will see discounts, but those discounts will be 5%, 10%, max out 15%, and so on and so forth. And Nykaa, the important thing that Nykaa did was they realized that there is no such, and cosmetics is an industry where you're literally applying this on your skin and it can have adverse impact, right? So you would not want to play around with that. What Falguni Nair, I think, realized really early on is that there is no real brand or nothing branded in that space, which is there in India, which can provide that trust factor and everything which is available under one banner. And that's what I think she's brought on the table. And there's a great story. In fact, Nykaa is one of those startups where I'm not really worried because when Nykaa, if you actually even hear Ashneer Grover talk about Nykaa, what he says is that when you are delivering anything in an online model, if you're delivering something which is of almost a value of more than 1,000 rupees, then there is some business. But if you deliver something which is less than, let's say, 500 bucks, 600 bucks, then the idea is that there is no money. And all these online groceries, these guys are delivering for 100 bucks. If the value of the item is also 100 bucks. So the good thing with cosmetics is that you're not going to find any cosmetic which is of 100 bucks or 200 bucks or 300. You're always going to have a ticket size of 4,000, 5,000, 10,000, whatever, so on and so forth. And since cosmetics are expensive and they are coming in small boxes, which doesn't require a lot of logistical effort, there is a great business aspect to Nykaa. There's no doubt about it. The idea is whether the spend that is going in as far as the marketing, whether that's commensurate. And the second one, whether the valuation at which Nykaa is, whether that is logical. So I think that is a more important question. But from a business standpoint perspective, I don't see any challenge that Nykaa should face.
Yeah, we can take a next. We have a question answer also, I think.
Yeah. So exactly. So I think we've got answers which states that we should essentially be looking at income approach. I think income approach would have made sense for startups because the idea is that cost for any startup, what is the cost? Cost is human resource, right? Human resource is not recorded on the asset side of the balance sheet. So they're not really going to have any assets. So cost approach goes out for the window, goes for a toss. You can either apply income approach or market approach. But the problem is that since the revenue generation has just about started, there is no financial indicator that you can apply the market multiple on. So the only option that you are left with essentially is income approach. All right. Let's say if I was trying to value Patanjali, what approach would I use? Income, market, or cost? Patanjali is an unlisted entity and they are into Ayurvedic products. So if I was trying to value Patanjali, what approach would I use?
Of course, market.
Okay, I'm getting market.
Market approach.
I can use both. I can use income as well as market. All right. And in case if they are looking at it from a high growth standpoint, if there's a very, very high growth, then maybe I would want to give a higher weightage to income because the growth could maybe, historically the growth hasn't been there or, the estimated growth is very, very high. So I might want to take a look into that. And say, for example, I was trying to value a bigger company like Tata Motors or Tata Steel. Then in that case, what approach should I use? Income, market, cost.
Cost,
again, I think we can use all three. We can use all three. There's no problem because there's income that has been generated for Tata Motors. We have comparables, so we can use market as well. And replacement cost also would be available, so we can use cost as well. So the idea under valuation is, again, moving to that concept of range, which is very, very critical. As far as methodologies which are possible, you can go ahead and apply those methods and then try and derive a range with respect to valuation. And then that could be used as the range for values. Yeah.
Can you add something on the weightage to be given for each valuation? Suppose
sure. So there are a lot of case studies with respect to weightages as well. One of the famous case studies talks about the HLL case, which talks about the fact that weightages could be given from the perspective of 2:2:1, which says that 2 is the weightage that you can give for income approach, 2 is the weightage that you can give for market, and 1 is the weightage that you can give for cost. Now, this is slightly dated, but a lot of valuers have relied on this and they've said that 40% is income, 40% is market, and 20% is cost approach using this case. But not necessary. I see a lot of valuers in the last 4 or 5 years taking their independent calls where they realize that, I don't have a very, very exact comparable. But I still want to rely on the market. So I'm using market approach, but I'm giving a slightly lower weightage and I'm giving a higher weightage to income and so on and so forth. So when we say that valuation is an art, apart from being science, so this is where the art comes into play.
Value is free to determine the percentage which he needs to give.
So till the time the valuer is determining the percentage on the basis of his understanding and his analysis, that is great. Valuer should not first decide the value and then decide the percentage later on. That could be a challenge.
Yeah, that's a big challenge.
Venkatraman is saying, another famous example can be for the client group of each round of the diversified according to the market needs.
Oh, that I'm not sure on this case, but that would be pretty crazy, right? Like if you do that, that means that there is something going on with respect to your valuation. And I don't know. I hope that the same firm has not signed all those valuation reports, because then that would be again even far more crazier. Yeah. So I'll just take you to certain issues and challenges with respect to why, it is a little difficult to estimate value. And for issue of sweat equity or ESOPs and what time? Yes, so Venkatraman sir, yes. So valuation is required for ESOPs. Essentially, valuation for ESOPs is a multiple level exercise. The first one that you'll have to do is when you're granting ESOPs, you will have to get a valuation done. This will be from the standpoint of accounting practice because you'll have to record ESOP as a cost. Second thing, you will again have to value those ESOPs at the time of exercise. Because what is going to happen is you will also be required to value this from an income tax standpoint because these ESOPs will be treated as perquisite under Section 17. And lastly, once you have these ESOPs and you're selling of these shares from a capital gain standpoint, again, you would require. So technically 2 levels, one from a perquisite standpoint, which is taxation, and one from an accounting standpoint, which is counting.
There's another question has come. There's another question has come.
Yeah.
Whether the valuation is required to be done on a sweat equity also.
Yeah, that's exactly what I'm talking about, right? Now, and from a sweat equity standpoint, we would want to see what is the consideration that is going and so on and so forth, whether we can be treating that as ESOPs or if that is sweat equity or it is in lieu of certain services that they are bringing on the table. So there are a lot of intangibles that certain people bring on the table. Then you might want to value those as well, value the company and then allocate a reasonable stake.
You're also asking at what point of time?
Yeah, I answer that. So first is at the time of grant, you would require the valuation because you have to record that as an expense. At the time of exercise, because that will be regarded from the perspective of income tax. From both time perspective, it would require valuation. All right. So certain challenges that we generally face in terms of valuation and very critical is one of the most important considerations that we face is everyone wants to get a valuation done in 2 days or 3 days. Always remember that if someone comes to you and they want to get a valuation done in 2 days or 3 days, what were they doing up till now? Right. So that's the first question that you should ask. Unfortunately, a lot of practitioners, because they think that, there's a new business line and, we don't want to lose out, they go ahead and accept the engagement. Never accept it. Whenever my practical experience says that if you have 2 days or 3 days to do any engagement, it basically means that your client doesn't want you to go into deeper details. And that basically means that it could be very, very risky. So whenever someone comes and tells you that, oh, we don't have time to do valuation, you should just simply say, oh, sure, no worries. We would want to give this a skip. You should honestly go ahead and do it because you cannot do valuations in 2 days, 3 days. So another thing that I've seen is, and which is very, very amazing is, if the client gives you every document that you asked for and everything is in order, again, it is a red flag. Because if everything is in order, it basically means that the valuation is already done by the client. He has already done it and he's just giving it to you from the perspective of signing. So you have to be very, very careful on such. People get very happy that, oh, they've given all details. But I get a little scared because when all details come in, this is generally never happens. But if it happens, then you have to be really, really skeptical that why have all details come into play, right? Third, don't do desktop valuations. Please don't do desktop valuations because desktop valuations are not really going to add any value. It's just a number crunching exercise. And fourth, if we are going to end up doing just number crunching exercise, this is more from a standpoint or issues. All of this is going to get automated. All our practice lines, practice areas are going to get automated. The next 10, 15, 20 years, you'll see all of this getting automated. So how do you get the human element into this? Is by learning the nuances as to what all elements or what all aspects you're supposed to look at from a valuation standpoint. Okay. Fifth, do not believe whatever the client says or do not believe in the projections. Try and test check them. Sixth, always remember that there will always be a comparable. If the comparable is not in India, the comparable will be in US. If the comparable is not in US, comparable could be in UK. The idea is that always try and rely on what the market is giving you as an information. Don't just rely on income approach, because income approach is based out of Excel. And Excel, we have this theory that if you put in garbage into Excel, you'll get garbage out. We call it the GIGO theory, garbage in, garbage out in a firm, which basically means that if you want to use an Excel to get to any value, you can get to any value using Excel, but that is not how you should be looking at it. Yeah. So these are all certain aspects that you should be looking at. I'm also giving you certain books that you can start reading. In case if you are, so there are two famous authors, Mr. Ashwath Damodaran and Shannon Pratt. These are two books which are regarded as Bible from the evaluation industry standpoint. So you can start reading out on these, and this should give you a good idea in terms of what this industry is about, and what all is required, prerequisites, what all you should be looking at, how you can excel eventually going forward. Yes, Bala sir and Devang sir and Atul sir, that's it from my side for the day, and we can open the floor for questions, discussions that we want to do.
One thing I will agree with you actually, because the valuation is not the thing which can be done in about 2-3 days time or something like that. Because I also dealt with the valuation aspect of it with one of the firm, maybe you may be knowing, this is somebody called the Rothschild and company with whom I've been actually dealing with. I know what is the task, what is the information asked for, what are the clarification asked for, etc. and all these things. It is really, a marathon exercise, and the valuation report is actually given. It is elaborately stated what are the things taken into consideration, what are the assumptions, what are the things, everything they listed down very clearly on that. It is really, the exercise which runs depending upon the firm, depending upon the assumption, depending upon the availability information, etc. and all this thing. It is hell a lot of time it takes actually. It's a nice to hear from you the good learning on all these approaches. Is really a good learning process for me today. Yeah. I think I read out all the questions, whatever so far it has come. If anybody has got any more questions, I think we can take up.
Okay, this is Venkatraman here. Can I speak, please?
Yes. Why not?
Yeah, first of all, thank you very much, Mr. Nitesh, for an excellent presentation, really insightful, and gave us a lot of inputs on this new hot topic of valuation, how it has to be approached. Do not take any position given by the client at face value. Fair enough. But I'm looking forward to the presentation which will perhaps the institute will organize on the intangible, because we are living in a knowledge economy. Living in a knowledge economy, there are certain intangibles which cannot be valued, but the efforts put in by the promoters, the efforts put in by the founders. We have examples of Mindtree, where then the coffee day, whatever, they invested a lot, the founders invested a lot. For some reason, they couldn't make the money, but they have marquee customers, which I told in my chat box also. How do we look forward for intangibles, which has marquee customers, number of users, platform created, for you to generate business at a later date?
So from an intangible standpoint, say for example, you have customer relationships, then you can, and that's one of the main core assets of the business has. Then you can value that using multi-period excess earnings methodology. So every intangible that you're talking about can actually be valued, whether it is human resource or the assembled human resource, that can be valued, to a brand that can be valued, to a software that has been created that can be valued, to a customer relationship, to a distributor network, to a IP, to whatever. So any intangible that we're looking at can actually go into valuation under all these approaches that we spoke about. It's just that all those methodologies are far, like it's 1.5 hours is a very less time to kind of delve into all those subjects. Maybe when we get into another seminar on these valuation of intangibles, I can elaborate on each and every methodology with respect to valuing intangibles. But essentially, apart from goodwill, which is a price that you're going to pay over and above what the valuation is, and that is what is going to be recorded as goodwill on your books, which technically I treat goodwill more as a balancing entry than anything else. Every other intangible technically can be valued.
Thanks. Looking forward to that session, Mr. Nitesh. Sure. Excellent. Gives you a lot of inputs, and for professionals like us, gives you how to look at it from a different perspective, in this knowledge economy.
Sure. Sure, Saul.
Atul bhai, thanks Mr. Balakrishnan, thanks Mr. Devang. Looking forward to be attaching with you all professionals. Gave a lot of insight on a Saturday afternoon today.
The whole purpose of organizing the Saturday seminar is only to share the knowledge and see we get enriched ourselves.
Absolutely, agree, 100% agree.
The knowledge is something like the more you know how much less you know.
Yeah,
it's a question by itself.
Well said, sir. Well said.
Yes. Continuous learning is the experience which is never ending. It is unending.
You never stop being a student. You're always learning.
I'm thinking of learning, this valuation, and learning this forensic, which is the buzzword now, the forensic expert, the cyber hacking or whatever, those are the buzzword which are now catching up. The different professional institutes organize these courses, but it all depends upon faculties who will organize this session, like Mr. Nitesh, one such, they're all excellent speakers.
Yeah, I think we just got one question. Pranali is asking why is it so that open price of IPO is always high and gradually correction happens. So this is the gimmick of what is called as the exit prices. So there's something called as a lock-in period, Pranali. And once the IPO comes in, the employees or there are certain people who are being earmarked where the shares are locked in for a particular period of time. Generally, this could be 6 months, it could be 1 year, depending upon what the timelines are. And whenever those lock-in periods will get done, you will see a lot of selling pressure. And once the selling pressure starts coming in, that's when the price starts dropping. In fact, even right now, a lot of people are hailing that it's a masterstroke that Nykaa has done with issuing bonus shares. But that's just, just looking at trying to ensure that the price doesn't go further. But the idea, to answer your question, it's more from the perspective that once the lock-in periods are over, everyone who has a particular stake or whatever, the selling pressure is immense. Because they want an exit. Someone very rightly said that IPO is a time when, you just eventually hand over stocks at a very, very high price to the retailers. And that is something that you should be very, very wary about. All right. There are a lot of people in the market who believe that IPO, if not handled really well, can become a doom for the retail investors who are investing into it.
Also,
and I'm sure,
Sorry, it also depends on the floating stock which is available in the market.
Correct. And also, I think even our regulators are becoming very stringent. If you see, there's a lot of movement which is happening in terms of they're looking at startups to kind of ensure that all the indicators which are used for valuation are very clearly spelled out. What are the movements as far as those indicators are concerned? So let's say if I'm doing a valuation of a company which is into software, then what is the average recurring revenue that they're getting from clients becomes a very critical standpoint. And SEBI wants that all the critical areas or drivers should be listed down and how they are moving ahead. So as I said, as the subject becomes, there's a lot of interest that's generated in the subject. Everyone will evolve, from practitioners to regulators to everyone who are reading these reports. All of that is going to evolve. And all of these are great signs for our economy, because essentially what we can look at is that the country as a whole, I think we're moving from developing to finally get to the developed phase. And maybe the next 10, 15, 20 years, that's what we should be looking at.
One question from my side, Nitesh.
Sure.
Now, for an unlisted company, would it be better, instead of going for a series of funding from different venture capitals or PEs, would it be wise? There are different funds created by the government now, the Self-Reliant India Fund, the Fund of Funds. Approach that, make the balance sheet clean, and then open it up for the series of funding so that you have value in the market.
I think the Startup India initiative, I think eventually would kind of take that also, because if you look at, I think there are a lot of activities that Startup India is doing. They have accelerators, it's an immense opportunity that is there on the DPIT website as well. So I think it's a call that the government needs to take, frankly, and. I think the startup economy or the story with respect to startups in India is there. Like, I don't see that as a challenge at all, frankly. Another question I think I'm getting is whether beta as one is acceptable. No, beta as one is not acceptable practice. It is something that the valuers used to do previously. If you're doing valuation for a private company, then there is a method called you're supposed to unlever the beta of the listed comparable companies and then relever the beta using your net equity and your tax rate. So we can do a detailed session wherein maybe, I generally take this as a basic preliminary session, and then we have Excel-based cases where I actually do live valuation, which is more insightful and you'll understand more in detail Maybe I'll check with Atul sir and maybe we can organize one of
Yeah,
those
yeah.
as well.
So probably, at least we can have something on intangible assets, because
Sure,
that's
sure,
very
absolutely.
subjective.
Sure.
Where, probably we need your expert,
Do that.
Somewhat complex also, intangible assets.
Yeah.
Done 100%. We'll do that. Fair point.
Yeah, Mr. Bala, we can close, in case we do not have anything.
I don't see any questions are there at this stage. I think we answered almost all.
Yeah, I've answered the last one.
Yeah, I think we can close the session.
Yeah. So thank you, Nitesh bhai, Devang, Thakar, for this wonderful support, and it was a wonderful presentations. And of course, it was very brief and short, but to the point. And yes, life is changing since we had those SEBI regulation, which earlier we used to have a CCI, Capital Control of Capital of India.
Yes.
I remember, early days when you used to handle those IPOs, you have to have those CCI valuations, been done so that companies are not charging any hefty premium. But since those regulations, and now there is a 360-degree change, and we have evaluations and everywhere under the IBC, under the Companies Act and all. And there are do and don'ts, inbuilt in section itself under the Companies Act. And of course, you also have the valuation under the income tax also. Now that's the subject by itself, and probably we require a separate.
If you want to talk
session
about
on
the
that
valuation and income, you don't have a separate session. That's a very, very vast subject.
Each topic will have a separate session.
Yeah.
It's so complex.
So that also probably we require that. So thank you, Mr. Bala, Devang, and Nitesh bhai, and all participants. This make us more positive, to organize such more webinars. And let's see, we'll in consultation with Nitesh bhai, we'll organize one more program on the valuation of intangible. Thank you all. Thanks, thank you very much.
Thanks a lot to everybody.
Thank you.
Many thanks.
Thank you.
Really a
Thank you.
good value addition session today. I'm very happy. Thanks. Have a good day. See you in some more sessions.
Thank you, Mr. Bala. Thank you.
Thank you.
Thank you.